Hello and welcome to Basic Bookkeeping, Episode 5, The Accounting Equation. Basic Bookkeeping is a free video course provided by Quote Vardamus Media Limited. Today we're going to look at the accounting equation. We're going to look at what is the accounting equation. We're going to look at what does it mean to a business and how is it calculated. If you've been following the previous episodes so far in this series, you'll know that this is the fourth in a 4-episode arc, building up to this episode. Episode 2 was all about assets. Episode 3 was all about liabilities. Episode 4 was all about capital and drawings. And we're going to bring assets, liabilities, and capital together, particularly in this episode 5, all about the accounting equation. And again, if you've watched previous episodes, you'll have seen on this slide every time we've seen that accounting equation, which is assets minus liabilities equals capital. And in many ways, this is the foundation formula, really, the foundation equation of bookkeeping and accounting. And there's so much we could talk about in relation to the accounting equation, but we'll get a very basic introduction to it today. And here's an example. This example is taken from our AAT Level 2 Introduction to Bookkeeping study guide, where we look at Morgan Rothby as she begins her business. And this is an example of a business that's been trading for a month, and they have assets, they have liabilities, and they have capital. So at this stage in the business, there are assets of £45,000, and that's a bank account balance of 16,500, machinery account balance of 12,500, so they've purchased machinery which has that value, a VAT account balance of 4,750, which is an asset because it's owed from HMRC, and we have a purchases account balance which is really inventory or stock of £11,250. That inventory or stock has a value, it's an asset to the business. And in the case of that 4,750, that's actually the VAT that was paid on the purchase of the machinery and the purchase of the inventory or stock in the purchases account. And VAT on purchases can be claimed back from HMRC, so it counts as an asset. So there are total assets there, combination of current assets and non-current assets, which we've looked at previously, of £45,000. But there's also a liability of £25,000. So when the business was set up, a bank loan was taken out of £25,000, and therefore that money is owed back to the bank in terms of £25,000. In the real world, in real terms, that would actually be a bit more complicated in terms of a liability, because of course it'd be interest and finance charges potentially as well, and they would need to be recorded in the bookkeeping. But we're keeping it quite simple for now. And that leaves us with a capital account balance of £20,000 because it's assets, £45,000 minus liabilities, £25,000 equals £20,000. And if you had the Introduction to Bookkeeping study guide, you'd see that the business owner originally put £20,000 of her own money into the bank. And then she's bought some assets, she's taken on this liability of £25,000, and she's left here with an overall capital balance at this stage of £20,000, which is the same amount of money that was placed into the bank when she started the business. And this is one of the key things of the accounting equation, is that it often balances. And sometimes changes in assets and liabilities will mean the capital balance changes, as we'll see in one of the examples in a moment. But often we'll see with assets and liabilities that the capital balance overall may not change, which is what we'll see in these examples we're going to look at now. So if we look at an example of somebody putting money into a business, slightly different example from the one on the previous slide, just to make the point. So a business pays £20,000 into the bank to start the business. That creates an asset of £20,000 in the bank. Minus liabilities, there are no liabilities at this stage, which is 0, which gives us capital of £20,000. So assets, £20,000, minus liabilities, 0, equals capital, £20,000. Next, the business takes out a bank loan of £10,000. So now we have assets of £30,000, which was the original £20,000 in the bank plus 10,000. So assets have increased by £10,000 to £30,000. Now we have liabilities of £10,000 because that bank loan money is owed back. So liabilities have also increased by £10,000. Assets £30,000 minus liabilities £10,000 equals capital £20,000. The capital figure is the same as the previous example because assets have increased by £10,000 as that bank loan money has been put into the bank, but liabilities have also increased by £10,000. So it's now 30,000 minus 10,000. Both assets and liabilities have both increased by £10,000. So our capital figure is still the same, £20,000. Now the business spends £5,000 on machinery. And effectively, if you are buying machinery, machinery is an asset. And if you are paying money out of the bank to pay for that asset, you're effectively buying an asset by using an asset. So you're buying the asset machinery by using an asset money in the bank. So the total assets figure here is still the same. It's £30,000. But now we've got £25,000 in the bank, which is a reduction. We had £30,000 earlier in example 2, but we spent £5,000 on machinery. So our bank account asset has reduced by £5,000, but our machinery asset has increased by £5,000. So the total value of our assets remains the same. We're just moving money to a certain extent between current assets, which was the bank account, and some of it into non-current assets, which is the machinery. Liabilities are still the same, £10,000. So capital is still £20,000 because our assets, £30,000, minus our liabilities of £10,000 equals our capital of £20,000. Finally, in these examples, the owner takes out £5,000 worth of drawings, and this one does change the calculation. It does change the capital balance because drawings have been taken out. If you remember from the previous episode, drawings has an effect on the capital balance. So now our assets are £25,000, which is £20,000 in the bank because £5,000 have been taken out the bank in drawings, so assets have reduced by £5,000 because £5,000 has been taken out of the business in drawings, plus the £5,000 machinery to make up the 25,000. Our liabilities are still the same, £10,000. So now our capital is £15,000 now. It was £20,000, but £5,000 worth of drawings has been taken out. If you remember from the previous episode, drawings reduces capital. So we had capital of £20,000, £5,000 of drawings were taken out. Now we have capital of £15,000. So it's a formula where the numbers will change slightly depending on what's going on. The capital balance may remain the same, but also the capital balance may change exactly as we've seen here. But it's a very good formula. It's a very good equation for working out what's the value of the assets in the business, what's the value of the liabilities in the business, and you really want the liabilities to be less than the assets. And therefore, what's the capital? What's the owner's investment in the business? What's the value of the assets that the owner or owners hold in the business at this point? So it's a great equation for finding out the value of a business. It doesn't tell you anything about the current trading history of a business. We need other statements, other formulas for that. But it's a great formula for giving you the value of a business at any given point. And that's why It forms the basis of what's known as the statement of financial position, sometimes also known as the balance sheet. Balance makes sense, doesn't it? Because the accounting equation balances. Assets minus liabilities equals capital. And that statement of financial position, we'll look at an example in a moment, is a snapshot of the financial position of the business at a given point in time. Now, commonly, that tends to be at the end of the financial year. Certainly, many limited companies are expected to provide a statement of financial position as part of their end of year accounts. And it could also be on request, for example, when selling a business or raising funds. A friend of Quo Vadis Media Limited were selling a business recently, and they produced a statement of financial position mid-year to show potential buyers of the business what state the business was in, to help them to come to a decision about buying the business. So here we see a very simple statement of financial position using the numbers that we saw 3 or 4 slides ago, using the assets 45,000 minus liabilities 25,000 equals 20,000. Now we could have made this statement of financial position more complex, and in the real world it probably would be. For example, we haven't subtotaled the non-current assets and the current assets. We've just totaled them in one go at the end. But it's very common in the statement of financial position that you'll see it laid out in a very similar way here. Non-current assets will quite often come first. So machinery, property, vehicles, etc. So that's why we have the machinery listed here first. Then in the current assets, those assets which sort of are very changeable in value, bank inventory and VAT owed from HMRC. Total assets, £45,000. Liabilities are listed. And again, we've had more liabilities. We might have to think about how we laid those out. But the bank loan of £25,000. Then we have capital at the end. Assets, £45,000 minus liabilities, £25,000 equals capital, £20,000. Just notice at the very top of this statement, it says statement of financial position. It says the name of the business, and it has the date of the statement. A statement of financial position is very much a snapshot in time at a particular point in time. So that is a very straightforward example, and in later episodes we'll look at these statements in much more detail of how the accounting equation is used in order to provide useful financial information, both for inside the company but also potentially outside the company, for investors, for government departments that require these accounts to be sent, for people interested in buying a business, etc. So the accounting equation is very important, and the statement of financial position which comes from it is also very important as well. So that's the end of our 4-episode arc on assets, liabilities, capital and drawings, and the accounting equation, with a little brief foray into the statement of financial position. Before we start looking into more bookkeeping, we're going to spend the next few episodes just touching on some different types of business. So sole traders, limited companies and partnerships in particular, although we may well touch on some other types of business as well. Sole traders and limited companies we've discussed very briefly in the episode on capital and drawings. But before we start delving into more complex bookkeeping, it's really useful to have an idea of what these different types of business are. So when we're talking about the differences between how sole traders and limited companies, for example, do things, we have an idea of what those different types of business entity are. So in our next episode of Basic Bookkeeping, episode 6, we're going to look at sole traders. We're going to look at what is a sole trader, how do they operate, and how does that affect the accounts for that business. So in the meantime, for more information, do subscribe and like our YouTube videos so you know when the next ones are coming up. You can also visit our website, which is quovadismedia.co.uk, for our range of information and resources for our online shop, and also information about the various publications that we have in print, where to buy them, and also access to those publications for Kindle and Kindle Unlimited as well. Do please follow us on these various social media channels as well, obviously here on YouTube, but also Twitter, Facebook and Instagram. If you search for Quo Vadis Media Limited, then you'll be able to find us nice and quickly and see what we're up to. And we look forward to seeing you in our next episode.